Welcome to Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Are my co-hosts today, Brad Lyons and Jordan Sute.
Hi, Casey.
Hello.
Hi, Casey.
How are you?
Good. How are you?
Good.
Good.
Well, today's topic is tax loss harvesting, which, I don't know, sounds very like we got to put our boots and jeans on. We got to go harvest.
Right.
But that's sort of it. I think it's actually one of the topics that maybe sounds kind of boring, but I think most of financial advisors should be doing this inside their clients' portfolios. And I think, I don't know, I'll just guess. I'd say 60% probably don't do it. They don't even think about it, especially the small solo shops. Probably never happens.
I wouldn't doubt that figure at all. Also, you have the idea that the advisor has to admit that something has gone wrong in the portfolio. There's a
Right,
security that has lost value.
That's true. Yeah.
And what we're really trying to do is we're trying to make lemonades out of lemon here. Is that the right analogy?
Well, I don't even think it's that. I think if you look at a portfolio, I always tell our clients we invest in long-term healthy asset classes. So if there's 14 different asset classes where of stocks and bonds, large, mid, small, et cetera, then those move at different times and do different things. So if you think about the financial crisis, you had a year and a half to take significant losses in your portfolio. But what most people ended up doing was they took the losses, they harvested the loss by liquidating the position, and they never got back in. Well, that's not what we're talking about today. Tax loss harvesting is looking at a loss in your portfolio, selling it so you can write off the loss or assign it to a gain. So it's a wash, right? And then reinvesting it immediately into something else. We'll get into that in a minute. But that's the bottom line, is just because you sell something doesn't mean it's bad. Now, in individual stocks, I could see that. Maybe a mutual fund, like a fund manager's making bad choices. But in index world, which is where we live, Vanguard, index funds, you're going to have periods where things underperform. And so you should take advantage of that. Right, Brad, you're in charge of that here at Wiser, and that's what we did during COVID crash. We did. We did
take advantage of those circumstances. Yeah. In the end, though, you want to start from the reverse, from the end of the story. At the end of the story, the portfolio is net. What you had, you end up still having. Okay, from an index standpoint. Right. Okay, and that's the point. You're really not changing the composition of the portfolio. You're taking advantage of a circumstance that has occurred in the portfolio in order to enhance your overall tax circumstance. But the portfolio, if done properly, remains unchanged.
So let's go into a scenario. I have a portfolio. It's 14 different asset classes, and there's a loss in the portfolio. What's the max that I can write off on that?
Unfortunately, just $3,000. No matter how big it is. Yeah, that's it.
But
whatever you don't take, you can carry forward.
But
I thought she was doing good on the first one there.
Yeah, I know. I was
like, way to go.
Well, she kept getting better. So I thought, let's just keep going. Well, I guess my angle on it is you also have gains out there.
Right.
Yes. So if I sell something for a $50,000 gain, I have something else for a $60,000 loss.
Right.
I've wiped out my gain.
Yes.
And then I still have a $10,000 loss remaining, of which I can only take $3,000.
Correct.
But it'll just keep rolling for my lifetime. Is that correct?
Yes, indefinitely. Until you use it all up.
So, okay. So that's not a bad thing. That's something we often do with new clients. Well, we'll always do with new clients with individual brokerage accounts. So I always look at Schedule D, correct?
D, yeah.
I always looked at Schedule D to see if there's any capital loss carryover.
And they do remain separate based on term. So if it's short term capital loss carryover, that's one number, and then you have a separate long term. So that's something to be mindful of. If you have this massive short term carryover, but you have all these long term gains, they aren't going to net. So you've got to kind of finagle your tax loss harvesting to work for your advantage there.
So let's dive into that a little more. You have short-term losses and you have long-term losses. So what is the difference between the two?
1 year. That's it. So if you hold an asset for 1 year, it becomes long-term. Anything less is short-term. Pretty simple.
And short-term has a different tax consequence.
Yes. Short-term gains are taxed at ordinary rates. which cannot always be favorable to us. Whereas the long-term gains are taxed at much more preferential capital gains rates. So 0, 15, 20% based on your income levels.
So for many people retired, more than likely their capital gains rate is very similar to their income rate.
Yes. And 15%, I think it kicks in at like $80K of income. And then 20% capital gains rate, it's massive. It's like $500,000.
Okay. And then there is a period of no capital gains.
Yes. Yeah. Up to $80,000, you have no capital gains tax on interest, dividends, and capital gains. Yeah.
So if I make $60,000 a year and I sold a $20,000 investment, I had $20,000 in gains. It netted $20,000. Then I would have no capital gains tax.
No capital gains tax on that $20K, correct?
Right, on a married filing jointly.
Yes,
right?
correct. Yes, correct.
Yeah.
But if I had a $100,000 taxable gain and then I made 60, it's 160. Now what happens?
You're moving into that 15% bracket.
So now it's the whole thing's taxed at 15%. There's not a portion that's zero. It's a hard cutoff.
Yeah, correct.
So that's why we have fancy software to help us figure this stuff out.
Yeah, yep.
Because there's so many moving parts.
Right.
You think about taking gains. There's so many things that can be affected by that. One, capital gains. Two, Medicare. If you're over 65, you could push yourself into a Medicare premium increase. Right. Which, by the way, is going up 14% in 2022. I just read this.
Wow.
Isn't that crazy?
That's crazy.
That's a whole different podcast, though, so we'll stay on topic. But, so yeah, you strategically, you have to kind of think about this before you do it.
Right. And then there's even the bigger tax, which is the net investment income tax, which kicks in at $250,000 for married filing jointly couples, an additional 3.8% on, and it's kind of a funny calculation. It's once you hit that 250, you're in the net investment income tax zone. And so it becomes, all right, how much is my income over 250? All of my income. So say your AGI is $300,000, and of that, 75 is net investment income. You're over 250 by $50,000 in total versus your net investment income is $75,000. You're going to be taxed 3.8% on the lesser of those two. So in that case, since you're 50 over, you'll be taxed 3.8% on $50,000 of income. So it's just an additional tax that kicks in once you're a high income earner. Big capital gains come in. So it's just something to keep in mind. That started
with Obamacare.
Obamacare, yes. Yeah.
Okay. So most retired people would not run into that 20% bracket. For it's safe to say that most would probably going to be 15% on the capital gains tax rate. So that's good to know. That's good to know, because if you take that during your working years, then it's going to be it could be much higher.
Right.
Okay, so let's go back to our portfolio discussion, and we think about a situation. I think we've talked about it here in previous podcasts, but during the COVID crash in the market, which ends up being very temporary, but at the time it doesn't feel temporary, right?
Right. You didn't know what next day was going to bring, and that was the thing about that market movement, is that you didn't know what was going to happen the next day. But so you're making decisions based on what you know today.
Yep.
And as we went through that period in time, you and I had conversations every morning, Casey, if you recall. Is today the day that we rebalance the portfolios? Do we think it's going to go down any further? How much longer can we ride this for our clients and get the best advantage point for our clients' portfolios during this crisis, not knowing what was going to happen tomorrow? So it was quite a discussion every single morning.
Yeah, and at that point, you're just guessing. We don't have any knowledge,
of course,
any
not.
more so than anybody else does.
All you have is experience,
yes,
and what knowledge that you have, what you're reading in the papers, what you're hearing on television, what you're getting from the media, okay, and trying to put it together and making a decision.
Yeah, I grew up this business in the financial crisis, 07, 8, 9. I actually bought this company in 07 from the original founder. And
we have a thing in our planning called bad timing.
Yes, exactly. Yeah. All right. Well, isn't that being great timing? Because it was a great education for me. I kept a journal during that time, and I actually pulled that back out during the COVID crash. And what I was telling my future self was, you take advantages of situations like that. So yes, there are many tough conversations with longtime clients about, no, we're not going to jump ship. Nope, this is really not that much different than anything else we've experienced. It's just a different cause. And what was interesting, though, is how many times I wrote in that journal, take advantage of the situation, because I was looking in hindsight. Another thing I said is keep cash reserves available too, which we've done that for 2 decades now. We've kept cash reserves available in all our retired portfolios. But the point being that taking advantage of the situation, we have a lot of clients that are very tax sensitive, and we were able to sell out of the S&P 500 and buy the Vanguard large cap fund. Now, the reason why we sold of the S&P 500 is because we're taking nearly from peak to bottom, with 30% loss.
Or so 32% drawdown. Yes.
Yeah. So 32% drawdown from the top, and especially for someone who was a newer client at that time, that was a big loss to take on paper. But we had other securities that we'd inherited in those accounts that we did not want to have. The client didn't want to have it, but they didn't want to pay the tax bill. So we generated those losses to then be able to liquidate the other holdings, right? And then we repositioned all that back into the portfolio. Now, what you have to be careful of during this time period is what they call a wash sale. You can't just sell the stock and then go back and buy the stock the next day for a loss. That's a wash sale. And wash sale rules is you just get taxed on, you don't get to write off the loss. Isn't that correct?
Right, that's correct. It'll be disallowed.
There's no penalty or anything like that. It's just not allowed.
Yeah.
So what we did was we bought something very similar. So you can't sell IVV, which is the S&P 500, and then go back and buy SPY, which is also the S&P 500. Okay, 2 different funds, but it's the same underlying holdings.
Right.
So you can't do that. But what you can do is go buy VV, which is the Vanguard Large Cap Fund, which looks a lot like the S&P 500. In fact, it tracks it very, very well, but it's not exactly the same set of stocks. And that worked out better than we'd hoped because VV adopted Tesla before the S&P 500 did. So VV outperformed IVV by, I think it was nearly 2.25%.
Yeah, it was well into that range over the long period. Yeah,
because it adopted Tesla stock before, and I think Tesla was up 800% or something like that, something crazy. So it moved up the index. You don't see that very often where one stock moves the whole index.
But this
by that
case,
much.
it did.
So in our case, we were able to take a loss, move into VV, which is very similar to the S&P 500. We got a surprise bonus of Tesla, and then we were able to either create a tax loss credit that will sit there available for us in the future, or we were able to liquidate something else and get everything in line with the risk tolerance that we were after inside that portfolio. So that's using a crisis to your advantage. Right. But even outside of that, there's still situations where even if it's just a smaller loss, a $3,000 or $4,000 loss, it might be worth it to swap out a fund. In fact, what we do here is we have a complete shadow portfolio, right? We have our core models, but then we have kind of like backups. Well, if we didn't have this one, we'd have this one. And that's how that works. And it works the same way in our Flight Path program through Betterment, except the computer does it instead of us, where it's going to automatically tax loss harvest as it sees opportunities.
Yeah, what you're referring to is a substantially identical security. So in the commingled fund world, ETFs and or mutual funds, etc., you can find other securities that allow you to participate in that asset class that are similar but not substantially identical. The substantially identical security comes in when you're buying when you own an individual stock, for example. You like the stock, you have faith in the company, but it's gone through a downturn and you now have a loss in your security. The ability to sell that, get a tax loss harvest, and if you want to remain in that stocks or company's asset class, you could buy a sector fund. You could buy something similar but not identical to remain in that, participate in that growth of that securities, at least sector, hold it for 30 days, sell it, go back into the individual stock that you were in, realize the tax loss harvesting opportunity, and 31 days later, you're still a stockholder of that company. So there are ways to do both, where you can hold a stock, tax loss harvest, remain participating in the asset class, but not the same identical company, hold that for 30 days, and on the 31st day, sell it and buy back the regular stock that you were holding. So that would be a method to
Yeah,
do
and
that.
I think we missed that earlier. You added 30 days to that. So if you sell security for a loss and you want to buy that security back and not be subject to the wash rule, you have to be out of it for 30 days in order to get back in.
That's right.
So some people will sell, wait 30 days, and then buy it back, but you have some risk that you're missing out on market gain potentially.
That's right.
So that's where you want to make sure that you're buying something of like kind.
Right.
Yeah. And with sector funds, I mean, there's some sector funds that get down to like 30 holdings or 25 holdings. So you can almost replicate the position that you were in if it's an individual stock position for sure. Yeah. So I think that there's a lot of, especially smaller firms that are missing this unless they've outsourced possibly asset management. It's something that DIYers don't necessarily think about or have the confidence to do inside their portfolios. But it actually adds to the rate of return overall. It's hard
after tax basis. Absolutely.
Yeah, correct. Now, your IRA, you won't have to do any of this,
right?
Because it's all tax sheltered, right? We're only talking about brokerage accounts in this case, but it's something to consider. But yeah, your total return can increase, and it doesn't. We don't even reflect that on a statement, honestly, because you have to look at the tax side of it,
right? Right. But as an advisor, when we look at portfolios and compare that to the objective for the portfolio, we become much more objective in our decision making. As an individual, the DIYer, for example, we gain an affinity for our holdings. We the longer we hold them, the more we believe in them. And it's harder and harder and harder to ever sell them because you're doing a couple things. You're admitting something went wrong. You're admitting that a mistake was made, perhaps when you bought it. Recognizing that you have to take action, which creates a decision in somebody's mind, not only to sell it, but then what do I do with the proceeds? Do I reinvest it? Do I something else? When you're dealing with an advisor who does tax loss harvesting, such as us, that objectiveness, that for the individual, our ability to be more objective, I want to say, takes over. We go ahead and take the loss, harvest it, reinvest the proceeds, and move forward from there. So it's a huge difference.
And if you take the loss in a stock and you turn back around and buy a bond, that's not a good idea because you're not going to actually gain anything back.
Right.
You just did a rebalance of your portfolio, so to speak. But
yeah.
a tax loss harvest, the idea is that you keep in the same car. If you're in a Porsche, you sell the Porsche and you buy a Lamborghini. That's probably a bad average. That's probably not apples to apples, but you get the idea.
It goes back to it's net to the portfolio.
Correct.
It was in the asset class. You're still in the asset class.
Right.
Only now on your tax form, you have a loss to write off against gains and or income.
Here with our software, we do it like a targeted trade. So we're simply going to pick fund XYZ and swap it out for fund ABC, right?
Right.
And it'd be equal swap dollar wise.
Yes.
So that way you're out of the market for less than a few seconds.
I remember when I first started working, I had a 1099 in front of me, and it was short-term gains and proceeds and basis, and it was like 25 million of proceeds and like 25 million of basis, and I was like, oh my goodness, this person has $25 million just out there in the market, and behind it was 300 pages of transactions,
Right.
So it's like, this is exactly what happened. It's showing a net wash in the end, but they were using losses to offset those gains so that they had really no gain in the end, if not even a small loss to take.
Yeah, exactly.
Mm-hmm.
It's a great way to help transition a portfolio. All right. I think we took care of that one. Good job, guys.
Well, it's a good
Enjoy
topic,
the conversation.
So yes.
Awesome.
See you next time.
Thanks.
Thanks for listening to the Wiser Roundtable podcast. We hope you enjoyed it. Make sure to subscribe wherever you're listening. That way you don't miss out on new episodes. Head to wiserinvestor.com and reach out if you have any questions. We would love to hear from you. Today's episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and unless otherwise stated are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.